In complex manufacturing and supply chain driven organizations, few achieve mature forms of integrated planning. Traditional financial and operational solution providers often claim to support fully integrated processes. However, the reality is that neither do, as critical capability gaps are falling between the cracks of solution providers. These capability gaps rarely affect small manufacturers, as they don't require sophisticated capabilities to optimize profits, make decisions, or overcome silos. However, this is not the case for complex manufacturers. These capability gaps have a material impact on their ability to achieve these management objectives. The reality is that when it comes to integrated planning, traditional solution providers have completely missed the mark, as neither financial nor operational solution providers provide mature forms of it. In small manufacturers, traditional rolling forecasts and integrated business planning often achieve the objectives shown on the screen, especially when there is no discernible difference between the two. For example, in some small manufacturers, operationally savvy CFOs are using FP&A solutions to integrate these processes into one that supports both finance and operations. In complex manufacturers, however, such process integration becomes increasingly difficult. As a result, these objectives aren't always fully achieved, especially when it comes to developing executable plans and using scenarios to support decisions that avoid cost and cash flow problems. The implication is that mature users of these processes and technologies rarely achieve maturity levels enabling dynamic cost and profit optimization, a level of maturity featuring direct cash flow projections and self-adjusting cost structures. These difficulties are often accompanied by increasing overhead costs and an inability to manage them. In most cases, technology limitations prevent manufacturers from effectively doing so. What this means is that neither rolling forecasts nor integrated business planning provides the means to effectively manage profitability because they don't enable manufacturers to manage all enterprise costs. The implication is that these traditional processes and tools are not equipped to optimize value because they don't support effective cross-functional trade-off decisions. Managing trade-offs has always been a key component of integrated business planning. Historically, however, it has narrowly focused on supply chain activities and outcomes, like those shown on the screen. Integrated business planning processes are less effective when it comes to managing broader cross-functional trade-offs. In fact, only 25% of companies considered themselves capable of doing so. Not only does this undermine their ability to manage value, it also prevents manufacturers from effectively managing customer expectations about service levels given cost constraints. This challenge becomes even greater when trade-off decisions must be made across multiple functions, business units, and legal entities. A classic example of cross-functional trade-offs lies in the introduction of new products, customers, and suppliers. As complexity increases, it becomes increasingly difficult to simultaneously quantify their impact on both financial and operational outcomes, especially on cash flows and costs, since these decisions can lock in significant portions of cost structures, as they can affect virtually every aspect of a business. Complicating matters even further are multiple introductions combined with key business changes. Without processes and models supporting the entire business, wrong decisions are often made that can cause complexity costs, which can amount to 3 to 5% of sales. These costs result from decisions having unforeseen consequences. The problem is that FP&A and IBP solutions do little to avoid these consequences. In other words, they're not supporting decisions having the most significant impact on enterprise performance. What's more, neither FP&A nor IBP solutions are effectively leveraging both predictive and prescriptive analytics to improve decision-making. This inability to manage cross-functional trade-offs is also one of the primary reasons why manufacturers experience difficulty sustaining cost reductions and achieving profitable growth. What's more, it also does much to explain why organizations experience similar difficulties creating sustained value from digital and finance transformation. Identifying and correcting such value erosion has been a central component of activity-based costing for decades. Countless manufacturers have used it to identify hidden profits and losses that are caused by inaccurate costing models, as illustrated by the graphic shown on the screen. What they've also learned from using ABC is that financial driver-based planning models are often wrong, resulting in over- and under-resourced objectives. This is the first of 5 key insights from the use of activity-based costing. What's required are operationally realistic models that accurately quantify resources across multiple entities and scenarios. The second insight is that profitability issues arise when customers are being over and underserved. What's required is the ability to manage cost, service, and quality trade-offs for all activities comprising customer experiences. The third insight is that profits can suffer when target setting and resource allocation processes are not effectively responding to market changes. What's required are concurrent ones that do. The fourth is that functional silos can cause unnecessary costs that erode profits. What's required are effective cross-functional alignment mechanisms to avoid this. Last, and because of the other 4, manufacturers don't establish effective accountability for profits. The reality is that you can't govern what you can't plan. By planning profits at product and customer segment levels, manufacturers will be better equipped to effectively manage a business within a business. Addressing these issues requires incremental capabilities that are enabled by mature forms of planning and performance management integration. These capabilities are described in more detail in separate videos. Collectively, these incremental capabilities allow manufacturers to establish mature forms of integrated processes that enable dynamic cost and profit optimization. What separates these processes from those supported by traditional solutions is that they enable enterprise integration, not just functional integration. Extended planning and analysis solutions are poised to enable such enterprise integration. However, while some may enable it in small manufacturers, most do not have the capabilities that larger ones require. What's needed are XP&A solutions that are specifically designed for complex manufacturing and supply chain-driven organizations. What differentiates such solutions is the ability to embed a single enterprise model that connects financial and operational targets and outcomes. This is accomplished with models that simultaneously plan both supply chain and non-supply chain activities. Such model integration is especially relevant for Treasury. This is because in global manufacturers, there is no difference between mature forms of supply chain and cash flow forecasting models. Further differentiating such solutions is the ability to share predictive and prescriptive analytics between finance and operations to support integrated scenario planning, especially when it comes to treasury optimization, as traditional solutions are not capable of supporting treasury optimization as part of a rolling forecast process. This reality remains a major flaw in traditional solutions. These models and processes provide the means to achieve value and benefits that traditional functionally based solutions cannot, the most notable of which is the ability to reduce complexity costs. Moreover, they can also reduce the cost of planning and managing manufacturing organizations by up to 50%. Despite claims to the contrary, traditional solution providers continue to operate in silos. As a result, the processes they support have not materially changed in the past decade. This reality explains why critical capability gaps continue to fall between the cracks of financial and operational solution providers. It also explains why they've not materially improved the ability of complex manufacturers to achieve universal business objectives such as profitable growth and sustainable cost reduction. In other words, it explains why their claims of supporting fully integrated planning is a myth. Thank you for watching this video. For questions and comments about its contents, please feel free to use the contact information provided on the screen.